I'm going to show you how you can do this technically without having to call up FinViz, without having to do anything except for become a technician. Price-based strategy using relative strength. We're going to toss out fundamentals because I know some of you are technicians. You love to go through life with blindfolds on. So for you, I'm going to give you your strategy. And the strategy is going to be, I'll show you the results of the strategy. The Dow Jones Industrial Average is the red line, and we see the blue line is a lot better than the red line. So we can beat the Dow without using fundamentals. The blue line, the line at the top, is a real simple one. We're going to buy the 5 strongest stocks in the Dow that are the lowest price and roll them every 6 months. We've looked at 3 months rolls, that's the green line at the bottom. We've looked at 12-month rolls, that's the orange line. The best roll period in the Dow is the 6-month roll. And I thought it would be 3 months. I tested it in a lot of ways, but the best relative strength approach in the Dow is buy the lowest price stocks that have been the strongest and hold on to them for 6 months, then roll your portfolio. Nice strategy, low brokerage commission. Again, we're not trading in and out. Low, easy to do strategy, not a lot of emotions to it. You do it twice a year. For those of you that can't spend 10 minutes 4 times a year, we have this strategy for you. We're going to spend 10 minutes twice a year. So that's a strategy that's strictly based on technical analysis.
And that's done quarterly too.
And this would be done on the end of every 6 months. Now there's another way I'm going to show you of buying these stocks. So we'll answer a question and move to the next strategy.
So on the relative strength, what time period are you looking at?
I'm looking at the last 6 months.
So 6 months.
6 months, the strongest stocks in the last 6 months. Again, you can make it a little bit better by getting the ones that were strong a month ago. But generally speaking, it doesn't do as well as fundamentals. But for those of you who want to look at relative strength, this is the best relative strength we've come up with.
It doesn't do as fundamentals.
But now, stay with the fundamentals, I think. Why bother? Yep. However, there is another strategy you can use. It does very well in, and I do implement this strategy I'm about to teach you now as well. I use it a little differently, so bear with me, I'll show you what I'm going to do. Okay, so I have stocks in the Dow, and I'm going to look for stocks that are stronger in the Dow. Notice this is Home Depot. The Dow went down here. It was a lot lower here than here, but Home Depot was higher there than there. Home Depot was comparatively stronger than the Dow. On a relative basis, maybe they're both up the same percentage, but on a pattern basis, this low is a lot higher than this low, and the Dow is lower. Do you see that stock stronger than the average itself, right? So I want to buy the comparatively strongest stocks in the group. And I went back and looked at the stocks you see in your course manual at the low in 2009. And there were only like 7 stocks in the Dow that were stronger than the Dow. They all took off, big moves to the upside. So it's a great, really simple technique. When you're at a market low, regardless of the market low, look for the ones that are comparatively the strongest. So I will use comparative strength, except I'm going to take it one step farther. I may use it on the Dow. Here's a test we did at the 2003 low. We took the comparative strong stocks. They were up 48% versus the Dow up 31%. The 2004 low, comparative strength stocks were stronger than the Dow. So it's a great technique, and all I'm looking for is a stock that is stronger than the Dow. So the Dow may have come down like this, and we're getting a 13-week rate of change, and the stock I'm looking for has come down like that. It's not making a new low. Well, the Dow is. I want to buy those stocks in the Dow. Careful. If you take this outside the Dow, you may be buying a gold stock or a stock that doesn't come down as much as the Dow. I want the stocks in the Dow to have the comparative strength. Now what I do to take this one step farther, The Dow stocks are great, but there's another group of stocks I like even better than the Dow, but I made them up. So it's not the Dow Jones Industrial Average. I like Costco, I like Philip Morris or Altria, I like Starbucks, I like General Mills. There's a whole group of stocks I happen to like. You probably have a group you like. So I will also buy of that group the comparatively strongest stocks at a buy signal in the marketplace. So if you have a group of stocks you really love, you follow a lot, you could substitute those on comparative strength for stocks in the Dow. And of that group, buy the ones that are comparatively the strongest as a long-term strategy where you're going to roll those every 3 months. Same thing applies. Just exactly like you do with the valuation, except we'll do comparative strength to get upward drift. Please.
When you're making this comparison, is it always a visual comparison, or you have some numbers, which you are comparing? So
No numbers. This thing, just looking for stocks that are stronger than the market.
So always one by one you go through?
I go one by one. In fact, we'll probably do that today. Go click, click, click. It's real easy to do. When we get online, we'll go through and I'll show you some comparative strength stocks. It's just, oh yeah, some a lot stronger right now in the Dow. We're at a buy in the Dow to see which ones are stronger. Real easy to do.
It doesn't matter if it's daily, weekly, monthly chart.
Now, I like to look at weekly, but it will appear on weekly, sure, absolutely. We'll look at comparative strengths in some stocks right now. So we're looking at now the 13-week rate of change, just so you're wondering about it. This is the 13-week rate of change. In the Dow, there was the buy signal, and look where we are now. We're not close to a buy signal. I'd like to get a buy signal in 13-week rate of change. I'd love to see the economy falling apart that much, but so far it hasn't happened.
Pass it at the green line, you mean?
The green line is negative 15%. That's where my buy point is. Okay, so with that, we can do this. We'll go look at comparative strength. So this is, we'll call this the Dow. This is the Dow Jones Industrial Average ETF. Because the Dow trades with a different time frame, being a cash market than stocks, it's hard to do them both in trade stations. So we'll just look through. This is the market, the Dow. This is Walmart. So what do we see? Well, lower price here and here, lower here, lower here. It's doing about the same, isn't it? Okay, so what if we look at XOM? And then we come down here and we'll look at, good. So who's got a stock in the Dow they'd like to look at? Let's just for fun do IBM. So here's IBM. Lower lows, they're all doing the same. In this area, they're doing the same as well. Not much difference, is there? So how about Home Depot? Oh, wow, look at Home Depot. Did you see a difference there?
Yeah.
Oh, yeah. The Dow's been coming down. Home Depot held the lows. So comparatively strong stock in the Dow, Home Depot. But you get the idea, right? You saw the big difference in Home Depot, and it just trades so much stronger than rest of markets, or than the Dow itself. So that's a great technique to use. If you don't want to use a fundamental valuation, just be in the 5 comparatively strongest stocks in the Dow. And that strategy has worked wonders for me. I first started doing this in 1966. So I had a long time using this little comparative strength strategy. Somebody came up from the break, oh yeah, Larry, I love your comparative strength. It's been very, very strong. So if you want a really good long-term tool from the Federal Reserve System, this is really long-term because this is what this index consists of. Non-financial corporate business, corporate equities liability, level plus financial business, corporate equities liability, divided by 1,000, divided by non-financial corporate business, corporate equities liability, level financial business, corporate equities liability, non-profit organization, credit market instruments, liability, level federal governments, credit market, all the money in the world, basically. The Federal Reserve has this particular index, and when it gets up in the area we saw in 1970, we're at bear markets, and when it's down low, markets are in good shape. There's just too much froth in the economy. And it's a good index. It hardly ever signals, though. As you'll see, I'll bring it up to date for us now. It just doesn't signal very often. And this is where it is now. You can see where it was in 2000. And it didn't quite get there in 2008. We're over here now. We're not in the red line zone. Does not speak very often, but when it does, we've had major bear markets in the marketplace. That's a very long-term indicator, but it's essentially all the money that we have in America. And when there's a lot of it, it's too bad. And when we're down here, we obviously want to be looking for a buy. Interesting indicator, but I know you want something more specific. So I brought some more specific things for you to look at today. News. This is interesting because I'm certain all of you either read Investor's Business Daily, Wall Street Journal, Financial Times, or watch the stuff on television. But the fact is, the reports show that most of the variation in returns for individual stocks cannot be explained using readily available sources of news information. There have been a couple of major studies done on this, and they cannot find any relationship between price movements and news of any substance. So stop reading the newspaper, or stop thinking that's going to give you the answer. I don't know. Some of you have been trading as long as I have. Have you ever seen a headline in the Wall Street Journal that says, buy Intel tomorrow, it's going to rally? No. In fact, if they have an article on Intel, they will say, well, this analyst thinks it's bullish, and they'll have another one that this analyst thinks it's bearish, right? They never have an opinion one-sided. They never say, they don't want to tell you to buy or sell, because they probably don't know themselves. They're just kids out of journalism school writing stories. But we think since it's in the Wall Street Journal and big words and stuff, it must mean something. But in fact, news really doesn't have much predictive value.